Live from New York City this morning. Good morning, good morning. Equities totally unchanged on the S&P 500. Wrapping up earnings season on Wall Street and shifting our attention over to Silicon Valley. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, coming up, global bonds rally as rate hike bets unwind. Goldman wrapping up earnings on Wall Street as investors gear up for numbers from big tech. We begin with the big issue, the right kind of downside surprise.
The narrative has been around inflation.
UK inflation
Coming in below expectations.
So much better than had been hoped for.
This is a step in the right direction.
It's a positive sign.
Inflationary pressures are still too high.
We should certainly not get overexcited here.
The Bank of England will still have to tighten interest rates further.
What do we see in the US? We see far greater progress on inflation.
This kind of disinflation mirage.
Disinflation everywhere.
We're expecting inflation to come down.
We should get even better numbers in Q3 and Q4.
I wouldn't be surprised if it starts trending higher.
We got to look for prolonged period of stability.
We're not quite done with this cycle yet when it comes to inflation.
The Fed needs to be still very adept in terms of monetary policy later this year.
Let's get straight to this bond market. SocGen Subhadra Rajappa, who is looking for lower yields. Subhadra, you've got them right now. Welcome to the program. Big rally in the gilt market. Treasury market rallying too, yields lower. Are we set up for a summer here of lower yields?
I think we might be set up for a summer of range-bound markets, given the fact that you have seen some progress on the inflation front, but the data, broadly speaking, in the U.S. is still relatively strong. We got a pretty decent retail sales print. The Michigan sentiment indices show that sentiment is improving. Consumer spending still remains relatively strong and robust. So you're going to see an environment where the strength in the fundamentals is going to support perhaps yields around these ranges. I mean, 10-year yields perhaps between 3.5% to 4%, before you see that leg lower in perhaps the fourth quarter. If we do start seeing a slowdown in growth and the potential for a recession in the first half of 2024, we're just not seeing it in the data yet. There are no imminent signs of a recession, so it's status quo for now.
There's more happy talk than that, though, Subhadra. The idea being that we can bring inflation down to an acceptable level, in the words of Jan Hatzius of Goldman, without a recession. Do you think that's possible?
We'll have to wait and see how the data plays out. I mean, March, when we had the regional banking crisis, that's a cautionary tale that you could see some disruptions in the market because of tightening credit conditions. The housing market, for the most part, has remained resilient. Even the interest rate sensitive sectors of the economy seem to be holding up, even though the Fed has aggressively raised rates. But that's not to say that we couldn't see a further tightening of credit conditions. You are seeing credit card delinquencies go up. You're seeing default rates start to rise in the credit market. So we're watching a variety of metrics to see if that will play out in the second half, and that could potentially lead us to a meaningful slowdown in the first half of 2024.
I want to bring George Borey of Allspring Investments into the program as well. George, wonderful to catch up with you. Just talking about these downside surprises, not just in the UK, but also in the United States over the last month, and whether you see further potential for this bond market to rally, for Treasury yields to drop.
Yeah, Jonathan, thanks for having me on the show. Good morning. Bond yields can trend lower over time, and we think we're at a point in time where, as we've seen a cool down in inflation. Growth has remained much stronger than people expect, but there is sort of expectations that kind of moderates going forward. And so we think kind of the structural backdrop, for interest rates are favorable. We saw a bit of a pop in 10-year yields just a few weeks ago, and that has sort of gradually come down. And so when we look at sort of the overall kind of macro environment for both fixed income and bonds more specifically, it's pretty favorable. We have very strong carry. Yields are ranging anywhere from, high 3s to 4% up to as high as 12%. That's a lot of income. And as yields kind of moderate, we get a little bit of capital gains as well. So bonds can do exactly what they're supposed to do in this environment. And we think that's a good thing for investors.
Well, let's see if we get the slower growth to take that Treasury market even further. Let me share two quotes with you, and you tell me which one you find more convincing right now. One's from BNP Paribas, or rather Capital Economics. Another is from Citi. This is from Capital Economics. Excess savings are all but eliminated. The impact of higher interest rates and tighter credit conditions will gradually feed through. Student loan repayments are scheduled to resume. We could argue that consumption growth will continue to underwhelm in the second half of this year. That's Capital Economics. This is Andrew Hollenhorst of Citi. Said soft landing optimism is premature. Tight labour markets, elevated wages, upside risk to shelter and other services inflation mean we do not share the optimism. Absent a tightening of financial conditions, inflation may re-accelerate in early 24. So, George, it's either consumption gets smashed in the second half or inflation re-accelerates in early 24. Which one is it, George?
Yeah, I think growth is held up very well and much better than people expected. One of the key factors that's in the market that doesn't seem to get enough attention is just the balance sheet strength of both individuals and corporations. And when you have lots of low-cost debt supporting your sort of asset base, that provides you with a lot of financial flexibility. And so that can help sort of the growth train kind of as sort of things unfold. It also means that inflation is not, perhaps gonna just sort of simply collapse. And it takes time to sort of get inflation down. Now we're in the sweet spot where inflation's coming down fairly quickly because of base effects and some residual sort of slowdown. But I think the latter risk of kind of a moderation of this trend, and that the risk was that inflation kind of goes back up or it doesn't go down as fast as people hope. That seems to be more of a risk than this kind of sudden collapse or meaningful hard landing. And it all goes back to that balance sheet strength. It's like a ballast. It's like an iceberg that's basically, effectively, supporting the economy. And that iceberg's pretty strong, until you get to that sort of cracking point. We haven't reached it yet. We're seeing some signs, as my colleague mentioned earlier, there are some signs within the credit market that default rates are going up, that higher costs of borrowing are weighing on some individuals and corporations in particular. But it's not enough. It's not enough to sort of meaningfully sort of impact, that trajectory of growth. It will come. High rates and an inverted yield curve will work. It will slow the economy, but it's that sort of ballast that's in the system that's still strong and still hasn't sort of eroded enough to kind of see that meaningful hard landing. So yes, recession's pushed out into next year. Is it hard? Is it soft? Hard ultimately results in these types of conditions. It's just taking a lot longer than people expected.
So, Badger, can I ask you the same question? Which argument are you more convinced by? That consumption gets smashed later this year, or ultimately things hold up and inflation reaccelerates?
So I agree with George's comments in the sense that I think it's going to be easy to get inflation. I shouldn't say easy, but it's going to be relatively straightforward to get inflation back down between 3 to 4%. But getting from that range on to 2% could take a lot longer. I don't know necessarily that means that there's going to be a reacceleration in inflation. It really depends on the trajectory for employment. When we were talking, George was mentioning cracks. We really need to see the job market crack meaningfully. And that's really where you're seeing a lot of the strength, is that the labor market is extraordinarily tight. And as long as people have jobs, they're going to continue to spend, and consumers are going to remain relatively resilient. That's not to say that inflation is going to gradually decline in the second half, and perhaps interest rates and Fed policy could accomplish lower inflation by just staying where they are right now. So I think range bound, Fed on hold for the remainder of the year makes sense. I think it's too soon to know if inflation is going to reaccelerate meaningfully next year.
Big rally in the UK government bond market this morning. We're down by more than 20 basis points on a 2-year, down on a 10-year this morning by around about 16 basis points, following softer than expected inflation data out of the UK. Mike McKay has the numbers. Morning, Mike.
Good morning, John. As you can see, UK inflation came down much more than anticipated, as did inflation in the Eurozone. And that has people thinking about where the level of interest rates needs to get to. Now, if you take a look at what we're seeing in the overnight index swaps market, U.S. Investors tend to think that the Fed is just about done. But while the Bank of England numbers have come down significantly, this is for end of the year, the base rate for them, there is still a feeling they've got a long way to go, and the ECB has a long way to go. The dotted lines are where we are now, and the solid lines are where they think they're going to end up. So even with the optimism in the UK today, much more work for the BOE to do, and much more work for the ECB. But the Fed may be getting to the point where it slows down. Now, Subhadra made a really good point about whether people have jobs or not. Take a look at what happened today in the housing starts market. While we saw a decline, we saw a big increase the month prior, and new home, single home family homes have continued to jump. So most of the weakness in multifamily homes, but there is still a lot of building going on. And what does that mean? That means you need construction workers. And if you look at the total number of houses that are under construction right now and the hiring, you can see hiring's fallen off. They're still looking for people out there to go help put these houses in the ground. And that just suggests that the labor market is another reason, at least, that the labor market's not about to crack.
Mike McKay, thank you. This post-pandemic economy is fascinating and frustrating at the same time, trying to work out what on earth is going on. George Borey, I know you're talking about the global inflation backdrop. It's something you and the team are focused on. Are you expecting regional inflation trends to diverge or converge? What are you looking for?
Now, we're expecting divergence as we kind of look around the world. You know, what we're seeing is that, you know, the global inflation shock is kind of dissipating, and then different economies are starting to diverge. You mentioned the UK already, you know, which has had much higher inflation than sort of other parts of the world, particularly here in the U.S., but even versus continental Europe, and some moderations starting to emerge there. But yet inflation in other parts of the world are starting to, you know, are either remaining high or in some cases actually been coming down. Places like some of the emerging economies, inflation's actually coming down. And so, you know, we're sort of well through that sort of global shock that we experienced, you know, sort of last year. The dissipation of that means interest rate differentials, you know, are starting to diverge at least a bit. You know, global, you know, rates as it relates to sort of the developed world do tend to move a little bit together, but we are sort of seeing a breakdown. And so, you know, we look at sort of opportunities to either, you know, invest in overseas bonds and perhaps bring those investments back to the U.S. by swapping those securities. Those, you know, can be very attractive to investors. But playing that dispersion, playing that divergence in rates is a really nice diversifier in portfolios. And that's one thing that we have been trying to implement, is really try to diversify that exposure away from just, say, exclusive dependence on U.S. rates, look to overseas markets, look to play that dispersion, and then bring those investment returns back to, say, a U.S. dollar investor. That's been a fairly attractive trade and opportunity this year, and we expect more of that as the year unfolds.
Subhadra, what's your take on that?
No, I completely agree with George. I think coming into this year in our year ahead outlook, our key trade idea was to go long treasuries versus bonds. And in the anticipation that treasuries will outperform bonds this year, we saw that outperformance where 10-year Treasury bond spread went from 170 basis points earlier on this year to 100 basis points during the regional banking crisis. It's widened out to around 140 right now. We do see that spread again narrowing one more time by the end of the year, given the fact that the ECB is still catching up on the policy front, and they're probably going to hike, a little bit more than the Fed, and they're also going to be a little bit more cautious about cutting rates or pivoting because of the fact that inflation is relatively high and higher than what we're experiencing in the U.S. You look at 5-year forward, 5-year break-evens in Europe versus the U.S., you're seeing that inflation expectations in the US are a lot more contained than they are in Europe. So higher for longer in Europe would mean that the divergence would probably hold up for a little longer this time as opposed to in past cycles.
Mr. Badger, just one more question from me on the Federal Reserve, if we can. A week away from a Fed decision, a week today. This just in from Bank of America and McKay and the team. This is what they look for. 25 basis point hike next week. They see this on September. We continue to expect another 25 basis point hike in September for a terminal target range of 550 to 575. So, Badra, is it one and done or more to come?
It's one and done, from my perspective. Really, to me, whether they hike once or twice is not very meaningful. If you're going to tell me that they're going to raise rates by 200 basis points to fight inflation, then that's a paradigm shift. 25 basis points at next week's meeting and another 25 in September or another 25 by the end of the year is not going to really move the needle, because the market's ultimately going to be looking towards what happens to growth and inflation over the upcoming year. And if growth is going to slow down meaningfully, then 10-year yields are going to trend lower. So the long duration trade is going to work out regardless, in my view.
Subhadra, that's Subhadra's bias right now. Yields lower, potentially, in the future. Subhadra Rajappa, George Borey, to the both of you, thank you. Appreciate it, as always. About 15 minutes away from the opening bell. Equity futures on the S&P 500, slightly positive by 0.1%. Plenty of earnings out there this morning. Let's get a few of them for you. Here's Abby.
There certainly are, John. And let's start out with the shares of Goldman Sachs, which are sliding but off the lows. This, of course, from a disappointing quarter on many fronts. Profits tumbling 58% on their investment banking business slowing down. Real estate concerns, plus the FIC trading, a bit of a miss there. AT&T up 6.1% as they say that less than 10% of their cables nationally have lead. Cowen is positive on the company's response to allegations made by the Wall Street Journal. Argus, on the other hand, has cut, seeing this as a new material risk, but investors siding with the bulls, up 6.1%. Netflix up 1.3% ahead of reporting earnings tonight after the bell. Investors think that they will put up streaming paid subscribers of about 235 million. Folks will really be looking for that crackdown on shared passwords. This stock on the year, John, up 61%. This will, of course, be one of the first big tech companies to go for the second quarter on these big gains. Will the results hold up? And how the writer's strike might impact some of these companies as well. Abby, we'll have a chat about that in about 30 minutes' time. Coming up, wrapping up earnings season on Wall Street.
Decent economic growth, stable markets, the banking system, balance sheets are strong, and consumer balance sheets are okay. That's a pretty good backdrop. The earnings are not really bad. They're not great, but they're not disappointing.
That conversation up next.
I do believe it's bottomed. Every CEO I'm talking to has tilted to a more forward-looking posture. So I think deals will start getting done. Whether they happen in the back half of this year, I'm not so sure. It might be next year that it comes, but it will be during next year when we see it, if not this year.
That was Morgan Stanley CEO James Gorman in conversation with Bloomberg's Sonali Basak. The bank earnings continued to roll in on Wall Street. Goldman Sachs seeing one of its weakest quarters under CEO David Solomon. Q2 profits plunging by 58% due to an investment banking slump and real estate markdowns. Regional banks under pressure too after Western Alliance fell short of estimates amid mounting funding costs. Let's get to team coverage. Bloomberg's Sonali Basak alongside Herman Chan of Bloomberg Intelligence. Sonali, that just about does it for Wall Street, doesn't it?
It sure does. And we have Goldman Sachs really biting the bullet here. You look at the commercial real estate losses, they're taking a hit to pre-tax earnings of $1.2 billion nearly. Now, remember, Goldman is taking these hits now. The question then becomes, do they have more on top of what they're already taking? And what does that look like across other firms as they continue to weigh that commercial real estate impact that could last many, many months? For Goldman Sachs, the sense is a lot of the pain is being taken right now. They're also taking hits on their consumer business here with a write-down of a goodwill charge charge tied to green sky. So the question for David Solomon is the worst over? Can we call this the kitchen sink quarter? Is everything thrown in here? Now, take a look at this. They did beat on some key areas. Equities trading, financing up there. The #1 shop on Wall Street this quarter around in equities trading. Underwriting is coming back pretty strong. That is usually a good signal for the advisory business. Fixed income a little short of expectations. But if you take it all in all, I want to give you the big picture here, John, for just a second, because Goldman's returns on equity were the worst across all the big banks, given the hit that they took. Now, if you take a look here at that 4% ROE they bought in, it would have been above Morgan Stanley at 9%. We'll let the market decide how they feel about the hits that Goldman have taken. But that's how the scorecard plays out for the year. As for David Solomon now, if you take a look, that 4% ROE, they're still expecting to make that mid-teens ROE over time, but it had peaked so far in 2021, at the end of 2021 for David Solomon. So what's his plan to turn this around?
Goldman right now down by 0.6%. David Solomon in focus. Is the worst over for him? Is the worst over for the regionals? Let's talk about the smaller banks outside of Wall Street. Herman Chan, the good news, deposits are back. The bad news, it's costing them a lot of money to attract those deposits. Should I focus on the good news or the bad news?
You should focus, at least this point, on the earnings trajectory going forward. The bad news with net interest income continue to decline, and a lot of the regionals, including U.S. Bank, Citizens today, PNC yesterday, are talking about some additional top-line pressure with net interest income declining in the third quarter with respect to higher deposit repricing. So it's going to be a bit of a slog going forward as regional banks sort of digest the higher rate environment and also competitive pressures from the likes of JP Morgan increasing their deposit pricing, which is reverberating across the regional bank space as well.
I'm going to sound like James Gorman. Things are getting better, but they're still not great on Wall Street and beyond. Shanali Basak, Herman Chan, to the both of you, thank you. Look out for more commentary from Shanali around the opening bell on some of these earnings calls. Looking forward to that. Equities right now positive by 0.1% on the S&P 500. Coming up in the morning calls and later. Deutsche Bank's Binky Chada joins us around the opening bell with his outlook for earnings and beyond. That conversation just around the corner. 5 minutes away from the opening bell. Futures just with a little bit of a lift by 0.1% on the S&P. That's the price action. Let's get you some morning calls. First up, Morgan Stanley raising its 20-year price target to 75, saying the stock will benefit from mounting AI tailwinds. JP Morgan upgrading Cisco to overweight, highlighting an inexpensive valuation and resilient earnings growth. That stock is up by 1.7%. And finally, Cowen raising its Microsoft price target to 390, expecting further upside due to growing demand for its new products. That stock is barely positive by 0.5%. Coming up, earnings season ramping up with more from the big banks and big tech results on deck. Tesla, Netflix after the closing bell. We'll catch up with Deutsche Bank's Binky Chada on his bullish call for the rest of this year. From New York City, your opening bell up next. .24 seconds away from the opening bell this morning. Good morning. Equity futures slightly positive by 0.1% on the S&P. Two-day winning streak on the S&P 500, the highest since April of last year. On the Nasdaq 100, the highest since January of 2022. Equity futures on the Nasdaq positive by 0.2%. There's the opening bell. Switch up the board. The focus will shift, of course, from the financials to tech. We'll talk about tech in just a moment, and the banks as well. In the bond market, yields are lower worldwide, and the gilt market much more so off the back of softer, lower than expected inflation in the UK. That downside surprise sparking a rally in the Treasury market too. We're down just a touch there on a 10-year yield by a couple of basis points, down almost 2 to 376.98. We snapped that winning streak for the euro in yesterday's session. The weakness continues this morning. 112.14 on the euro against the dollar, negative by 0.1%. And sterling cable down almost one big figure this morning, from 130 down to about 129 off the back of that inflation data. Taking a look at crude, we're positive there by 0.66%. WTI up about 50 cents to $76.25. About 40 seconds into this session, equities positive by 0.3% on the S&P. On the Nasdaq, up by about 1/3 as well. The sector to watch over the last week, the financials. Goldman Sachs wrapping up earnings on Wall Street, reporting its lowest quarterly profit in nearly 6 years. Western Alliance missing Q2 estimates as efforts to rebuild deposits come at a cost. Abby has more. Hey, Abby.
Hey, John, and yeah, both of these stocks are under pressure on these disappointing quarters. Goldman missing the adjusted earnings estimate by 22%. Those earnings tumbling 58% on a year-over-year basis on a myriad of issues. Their FICC trading missed. The investment banking was weak. They took a $1 billion impairment charge on commercial real estate. There was a goodwill write-down relative to the consumer business. Now, coming into today, the stock had been down about 2%. You compare that to JP Morgan into their quarter, up about 10%. These results not entirely a surprise. Now, relative to Western Alliance, it's clear that they are paying up for their deposits. Their interest expense grew eightfold to $451 million from a year earlier. This, of course, was a fear for all banks, but really materializing more so for these regionals. They also had some issues with credit quality on, in particular, corporate real estate and hotels. But the interesting thing, John, as you remember, during the height of the turmoil in March, this stock down about 90% year to date, now down 30%. So really coming back from those lows. The KBW Bank Index, well, at this point, it is down 15%, much better than when it had been down about 30%. So these financials underperforming on the year, but improving from the bottom.
It's getting better. Abby, thank you. And to Abby's point, the deposits are coming back for the likes of Western Alliance. That's the good news. The bad news, it's just costing more money. Interest expenses up 25% from the first quarter into the second. That's how much it's costing a bank like Western Alliance to attract that money back into the institution. Plenty of commentary out there this morning. This from Truist on that bank, reiterating their buy rating and writing this: Western Alliance has successfully demonstrated the ability to grow deposits and improve capital levels. We expect there to be some pressure on shares given the recent outperformance, lowered guidance and negative credit migration. That stock is negative this morning by 1.7%. Let's turn back to Goldman. The chairman and CEO, David Solomon, weighing in on the results. He said this: global banking and markets delivered solid returns, and we remained #1 in completed M&A. I remain fully confident that continued execution will enable us to deliver. The earnings call underway. Shanali, he's putting a brave face on this morning.
He certainly is. Everyone's calling it the kitchen sink quarter. This was a little bit expected here, but these write-downs are significant. Without them, they would have had an ROE north of 9%. But because they are here, it is worth addressing whether we'll see these kinds of losses again. Some of the consumer business won't take the same kinds of losses. And you did hear David Solomon just on the call talk about the risk-off posture that Goldman Sachs has taken in the second quarter. Now, this now becomes a story of what does the second half of the year look like. The pipelines are building when it comes to advisory, according to Goldman Sachs, and do the markets businesses also start to roar back? We have known that they've inked ROEs north of 10-20% in the last couple of years with those markets businesses. The markets have rewarded them. Today, Goldman Sachs is still trading at a higher price-to-book ratio than Bank of America, which is trading below its book value. And so these investment banking businesses have been rewarded. But again, the market is still flip-flopping on Goldman Sachs, not knowing whether some of these troubles are completely over.
James Gorman said to you over at Morgan Stanley yesterday, Shanali, that the worst might be over. Is that just for Morgan Stanley, or do you see that right across the investment banking business for these big players?
You know, it's funny. I talked to a few sources of mine at the tops of these big banks after that comment, and they said they won't necessarily always go as far as James in that comment to say that the bottom has been hit. But certainly things look like they're improving. Anything could happen. Here's the problem. After all the job cuts, even if the job cuts are done, John, attrition is still much lower than it had been. It's 50% over at Morgan Stanley of what it had been, which means it's not easy to find a new job necessarily as this activity starts to come back because the headcounts have swollen just so much, and there's still expense pressure on Wall Street. Good news for Goldman, the operating expenses without all of these costs would have actually been lower after those job cuts, which again, call that a bottom.
Shanali, thank you, and brilliant work as always this earnings season on the financials as we wrap up the numbers on Wall Street with Goldman. Goldman slightly negative around the opening bell. We're about 5 minutes into the session. We're negative there by 0.7%. Morgan Stanley just about unchanged. Goldman down about 0.8 as I speak and back to 0.6. To Shanali's point, all over the place, just in negative territory below that zero line in the first 5 minutes of the session. I want to stick with earnings. Shares of Carvana surging at the open. The company topping earnings estimates and reaching a deal to restructure its debt, announcing plans to sell up to $1 billion of shares as well. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, Carvana actually spooked Wall Street last night when it announced that it was going to move up its earnings release by several weeks. But turns out it was to announce pretty good news. Quarterly earnings beat forecast. And the reason why you're seeing shares up almost 41% at that moment is the agreement with the bondholders. It's going to eliminate about 83% of Carvana's 2025 and 2027 unsecured notes. All told, Carvana expects to reduce its debt load outstanding by more than $1.2 billion. And that's in addition to the stock sale that you mentioned. Now, Bloomberg Intelligence was out with some healthy caution this morning, writing that while this was a needed step, it's possible that further balance sheet restructuring will be needed for Carvana as the cash burn continues. But you're not seeing any of that caution in the shares this morning, currently up about 26%. For the year, John, Carvana is up more than 900%.
What do we call Carvana, Katie? Tech firm, auto dealer, what are they?
Right now, it's a comeback story. I'm not sure what you would call it in terms of what they do, but just astounding to watch this.
Every time I bring up that company, TK turns around to me and just says, what on earth does Carvana do? Katie, thank you. Carvana flying this morning by 29%. 6 or 7 minutes into the session, equities positive by 0.4%. The Nasdaq up by, let's call it a third of 1%. Wall Street warming up to the rally in a big way. Jonathan Golub at Credit Suisse, the latest to raise his outlook for stocks, writing this. We're raising our price target on the S&P to 4,700. They were, by the way, at 40.50. Their base case now is that a recession will be averted, inflation will remain sticky near current levels, and monetary policy will tighten only incrementally. Let's talk to someone else bullish on this equity market. Deutsche Bank's Binky Chada, 4,500 year-end price target. Binky, several months ago sounded bullish, not so much anymore. Binky, you were constructive and right. What do you see going right, going your way over the last few months?
So far, I would say, the most important thing that's happened, to repeat basically the obvious, is that inflation's come down. But I think that, a very important aspect of that has really been, really the opposite of the popular narrative, which is, better growth is going to raise inflation. What we've really had basically since the peak in inflation in June last year is, as inflation has come down, real incomes have grown, and they've grown basically pretty solidly. So, the trough, so to speak, in real incomes was in June of last year. We are now in the 13th month of, what looks like pretty solid growth in real incomes. And so, that is naturally basically pushing out the possibility basically of us, running out of, the consumer running out of savings built up and the like, because if income is growing, then consumption is going to grow, and you don't really need those excess savings. So I'd say that's been the most important development. I think it's mostly gone below the radar because of, this narrative focus on the Fed, that the Fed, if growth does pick up, well, growth's not necessarily endogenous, but we've had 13 months now of real income growth coming from declining inflation, or, really a faster rate of growth, really, of real income. And I think that's been the game changer.
Well, Binky, you say it's gone under the radar, but arguably the market's picked up on it. The cruise lines, 3 of them are in the top 10 performance stocks on the S&P 500 this year. The airlines are doing tremendously well. My question would be, can things get even better for discretionary?
I think that they can. If you look at, the cyclical parts of the consumer that are in consumer discretionary, I would say that's where, the extreme and relatively severe hard landing, I would say, had been priced in, and that's coming off. I would argue, the same is true really of the financials, and that's the two places where, in the event of a soft landing and, if this period of basically declining inflation and better growth continues, that's where I would argue you want to be long. Yeah.
As you know, Binky, these companies live in a nominal world. Can you talk me through the relationship you'd expect just at the S&P 500 between disinflation and revenue growth?
Yeah, so we have a take that's relatively different. I would say basically, we're not really concerned about what disinflation is going to do to earnings. I don't have this, one-line sharp, QED answer. But if you look back historically, if you look in the 1970s, for example, and you look at revenue growth, it was, very strongly correlated and booming with inflation. But if you look at earnings and you try to see what is the relationship between the real growth and what is the relationship of earnings with inflation, you'll see that it's all really coming basically from real growth, such as, so a good indicator would be ISM manufacturing, I would say. And what I would say is, the correlation basically with inflation is essentially non-existent. And I'd say, the answer is sort of complicated. The empirical evidence is basically pretty clear. But if you think about pricing relating basically to costs, and if you believe that that's going to be symmetric on the up and the downside, then the slowing should really not be an issue. The slowing in inflation should not really be an issue for earnings. Earnings going to be really much more about real growth. Indeed, as they were in the 1970s too.
So, Binky, let's put a bow on it. Your base case now, do you see the cyclicals taking a baton from what's happened with tech so far this year, or do they just rally in tandem? How are you thinking about that dynamic?
So we moved about 5 to 6 weeks ago to neutral from overweight on mega cap growth and tech coming into the year. We expected a big positioning squeeze led really by the mega cap growth and tech stocks. And so the NASDAQ basically leading. That's happened basically. And I would say there's the squeeze. The squeeze was followed really by a positive inflection basically in their earnings. But if you look at the price action, it has now far exceeded basically, what is expected out there in the future in terms of earnings and our own estimates. So I think it was a good time to move back down to neutral. And I would say since late May, mega cap growth and tech and the rest of the S&P 500 have basically been moving in tandem. So, the rally has basically widened out, but I would, keep that neutral rating basically on mega cap growth and tech. It's not a negative fundamental view. It's just a question of what's already basically in the price.
Binky, congratulations for the call so far this year. Constructive and right to be constructive in 2023 when others weren't. Binky Chadha there of Deutsche Bank. 13 minutes into the session, equities up by 0.4% on the S&P, on the NASDAQ up by 0.4%. Plenty of focus on tech a little bit later today. Coming up, Netflix kicking off tech earnings after the bell.
There's a lot of ways to look at the strike, but the bottom line is it actually makes them money not to make content. They can pare their costs. They can, get out of bad contracts and bad deals, and they can really focus on quality.
A conversation up next.
There's a lot of ways to look at the strike, but the bottom line is it actually makes them money not to make content. They can pare their costs. They can, get out of bad contracts and bad deals, and they can really focus on quality. And since they're producing content all around the world, they just focus on their international content, which has been phenomenally good and has no effect from this strike. So in a global entertainment world that Netflix functions in, really these U.S. actors are really just making themselves sort of in a weaker position globally.
Big tech in focus. Netflix earnings after the closing bell. The Nasdaq 100 recording its best first half on record, leaving estimates in the dust. Shares soaring past analyst price targets this year. Netflix, Microsoft, Apple and others as well. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, what are you and the team looking for after the close?
Yeah, so there's a lot of bullishness, John, a lot of optimism going into this second quarter earnings. Obviously, the big number that everybody's looking for is subscriber gains. And really, this is a momentous quarter in many ways because this is the first time after their widespread password crackdown that they're reporting numbers. So it's going to be interesting to see how many new subscribers they did gain and what their guidance is for 3Q in terms of, revenue growth reacceleration. They're not going to give any subscriber guidance per se, but they will give some guidance on revenue growth as well as operating margins. So I think that's what the street is really going to be focused on.
And let's face it, the subs guidance was always awful anyway, based on where it came in relative to what happened. Geetha, thank you. Geetha Raghunathan of Bloomberg Intelligence. We're going to touch base with Geetha again tomorrow morning after the Netflix results a little bit later. Mixed opinion over what's going to happen with Netflix. Also the writers' strike, several things we need to think about. Loop Capital's Alan Gold joins us now for more. Alan, can we just start with the crackdown on passwords first, and then we'll get to the writers' strike and the catalogue over at Netflix too. What do you think the sub-story is going to look like? Are people going to be taking up more accounts, or are people just going to be cancelling?
Thanks. Good morning, John. So the crackdown on password sharing is probably the biggest fundamental change Netflix has done in years. The company did give guidance that 2Q would be about 1.8 million, said close to 1Q. The street is at 1.8 million. There was some data that came out by a company called Antenna saying signups had spiked after the password sharing crackdown on May 23rd. So we know the gross ads are up. We don't know how much the cancellations are up. I would say the buy side is looking for 3 to 5 million net ads for 2Q. They're looking for close to 5 million in 3Q. We'll figure that out from the revenue guidance, how close that is. And that's what's driving the stock, was just the successful rollout of password sharing crackdown.
Well, the stock's up big time by 61%. Alan, would you go as far as saying that most of that's discounted then, going into this print?
Yeah, we think the returns are asymmetric going into this print. The stock's up 40% since they reported, over 40% since they reported 3 months ago. So I think this is well discounted in the stock. Listen, Netflix is winning the streaming wars. They're going to benefit, as your prior guest had put on, from the strike. They are clearly in the lead position here, but the stock's had a heck of a run over the last few months.
Let's get to that strike. Alan, I was reading your research. Why are they best positioned to ride out this writers' strike compared to, say, other streaming companies?
Sure, 2 fundamental reasons. Number one, Netflix has more content in production. They just have more content about to come out. So if everyone had to halt content over the next few months, Netflix would have more new content than anybody else. Secondly, Netflix is a global producer. So if the U.S. writers and screen actors are on strike, they can still be producing elsewhere. The biggest show in Netflix history was Squid Games, a Korean show.
Alan, just a final one from you then. Kind of on that, the difficulty that other streaming providers, other companies are having, not just making content, but having the money to make content. Netflix is making money. Others have been chasing subs and they've had to pull back. Alan, you said they're winning. I just wonder how you think that dynamic's going to carry out in the quarters, the years to come. Because you say Netflix has a better catalogue. That might be just because they're in a position now to be able to make the content. They have the money to do so. Are there others in a decent position with a strike or without a strike?
Yeah, I mean, listen, this year Netflix on an EBITDA basis will make about $7.5 billion. And the 4 largest traditional studios will probably lose $7.5 billion combined in streaming. So they're clearly winning right now. Listen, Disney's got a phenomenal library, phenomenal content. All the other streamers are raising price. I think their pricing was too low. But Netflix is the clear winner. And we just don't know. Amazon will be big in this business. They're spending a ton of money. You never know where Apple's going to do. But yeah, I think we have to have consolidation of the other streamers. And you'll probably end up with three or four large streaming companies. So there'll be some consolidation. Pricing will be raised by the others, and marketing costs will come down, and they'll eventually turn profitable. But Netflix clearly has the lead and will be the long-term winner.
Alan, you say consolidation. Who's getting married? What kind of tie-ups are you looking for?
Well, Paramount to me is the most obvious one. It's relatively highly levered. They're losing a fair amount of money. This is supposed to be the peak year of losses. Management hasn't given us any indication when they turn profitable. I could see Paramount tying up with someone, or at least their streaming business. Yeah, at Comcast, they're losing $3 billion this year. At Peacock, again, it's supposed to be the peak loss. Interestingly, Paramount and Comcast, or NBC Universal, have a joint venture in Europe called Sky Showtime. I could see something like that here. And HBO Max, they've got great content, or Max as they're now calling it, great content, but they're pretty heavily levered. They're going to have to figure out how to, they have turned profitable, they say, in streaming, but they're going to have to get a lot more profitable given their debt load.
Alan, thank you, sir. Great to catch up going into that print. Alan Gould there of Loop Capital on Netflix after the close. Coming up, your trading diary with equities right now positive 0.4% from New York. This is Bloomberg. Twenty-five, 26 minutes into the session, stocks higher on the S&P for a third consecutive day. That's the price action. Here's the trading diary. Coming up a little bit later, President Biden discussing consumer protections at 3 p.m. Eastern Time. Netflix and Tesla report after the bell. Head of American Airlines and regional banks, including Truist and Fifth Third tomorrow. We also got another round of jobless claims, plus existing home sales, and more earnings Friday, including American Express. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.